let's take a look at problem 7-3, which deals with bad debt reporting and aging. Ignace Pedorowski Corporation operates in an industry that has a high rate of bad debts. Before any year-end adjustments, the balance in the company's accounts receivable account was $555,000, and the allowance for doubtful accounts had a credit balance of $35,000. The year-end balance reported in the balance sheet for the allowance of doubtful accounts will be based on the aging schedule shown below. And to the left of my mouse, you see that we've got the aging schedule listed between ranges of time, or how old the account is, the dollar amount, and the probability of collection. Okay, then on parts, we're going to tackle parts A, B, C, and D, which we'll solve on a separate page. So let's take a look at part A first. Okay, part A says, complete the aging schedule to determine the appropriate balance for the allowance for doubtful accounts at year end. Okay, let's drop in the information that we know. And I've worked this ahead of time just to save some time. So if we bring the font color in, we know that here's the dollar amounts from our data of 0 to 15 days, 16 to 30, and so on. And then if we wanted to determine the expected percentage uncollectible, what we would do is take 100% minus the data we presented. So 100 minus 98% means there's a 2% chance of being uncollected. At the 16 to 30 days, it's at 10%, 100 minus 90. So if we drop all of those factors in, we wind up with an expected percentage uncollected. Then we can simply multiply the number of times the percentage to come up with the estimated uncollected, right? So we would take 300,000 times 2%, and we would take 100,000 times 10%, okay, and so on. And that would give us all the values that we have appearing right here in column E. All right, once we've done that, then we can just total it and determine that the balance for allowance for doubtful accounts was 50,000. Now, over 75,000, I think it was 100%. Yeah, we've got a 0% probability of collection after it's over 75 days. So what that means is accounts which have been outstanding over 75 days, which is $15,000, and have zero probability of collection would be written off immediately and should not be considered when determining the proper amount for allowance for doubtful accounts. So that's something to keep in mind. Okay, let's take a look at Part B now. Part B says prepare the adjusting entry to record the bad debt expense. Okay, back on Part A we had a total of 50,000 is what the allowance should be. So if we bring that to light, what we should recognize is, let's put a couple columns down here. We should recognize that the year-end bad debt adjustment would decrease before tax income 30,000, and here's how we compute that. We came up with the 50,000. Then the next thing we need to do is determine the balance in the account after the write-off of the bad debts, and it would be 20,000. So what that means is we need to record a $30,000 expense, right? So to get us to the proper amount. Okay. So the balance in the account after the write-off of the bad debt accounts, but before adjustment, was 35 minus 15, and the amounts that we had written off was 35,000. So that's where we come up with the 35,000 amount. Okay, so then the adjusting entry is simply a debit to bad debt expense for 30,000 and a credit to allowance for doubtful accounts. All right, let's take a look at Part C now. Part C says show how the accounts receivable would be presented on the balance sheet. Well, we would start off with showing accounts receivable at 540,000, and then we would show the allowance, and that would drive down to a net accounts receivable of 490,000. And that's all that's required on Part C. Now Part D says indicate how well the percentage of sales method and the aging method accomplish the objectives. Okay, this is a narrative, and I'm just going to bring that all to light, and we'll read it here. The percentage of sales method says that bad debt expense is debited and the allowance for doubtful accounts is credited with a percentage of the current year's creditor total sales. So the rate is determined by reference to the relationship of the prior year's creditor total sales and actual bad debts arising therefrom. Now, consideration should also be given to changes in credit policy and current economic conditions. And the reason for that is that you're trying to do the most proper matching of the expenses given the revenue. So if something changes, the history may not duplicate itself. We want to consider what that change could be and make our best estimate to predict it. Okay, so although the rate should theoretically be based on and applied to credit sales, the use of total sales is acceptable if the ratio of credit sales to total sales does not vary significantly from year to year. Now, reading the second paragraph, the percentage of sales method of providing estimated uncollectible receivables is intended to charge bad debt expense to the period in which the corresponding sales are recorded and is therefore designed for the preparation of a fairly stated income statement. Due to the annual insignificance but cumulatively significant errors in the experience rate, meaning how well this model is working, it may result in excessive or inadequate balance in the allowance account. This method may not accurately report accounts receivables at the estimated net realizable value. And how you would get around that is you would periodically review and adjust the balance in the allowance account based on changing circumstances. And the materiality of any such adjustments would determine what the treatment would be for reporting purposes. All right, let me slide up a little bit. The necessity of such adjustments of the allowance account indicates that bad debt expenses have not been accurately matched against related sales. Even when the experience rate does not match an excessive or inadequate balance in the allowance account, this method tends to have a smoothing effect on reported periodic income due to year-to-date differences between the amount of bad debts expense and estimated bad debts. So that's something to keep in mind. Now, with regard to the aging method, what this method does is it takes each year's debit to the expense account and credits to the valuation account by evaluating the collectability of open accounts receivable at the end of the year. An analysis is performed of the accounts according to the due date of the stratified accounts receivable. And for each category, an average percentage rate is applied on the basis of past experience, and then it's applied to the accounts in the respective age categories. This method also utilizes individual analysis for some accounts, especially those that are considered past due, in arriving at estimated uncollectible receivables. So on the basis of this, the balance of an aging method is adjusted and we follow this procedure to determine the amount or the estimated amount that will be uncollectible. Okay, so for the most part, I've just read the published solutions that deal with Part D, but you're welcome to look at them, pause the demonstration, and read them slowly if that is valuable for you. Okay, so again, we took a look at this problem. We calculated how to determine the allowance for doubtful accounts, how to determine the amount of the adjusting entry, what it would look like in the income statement, and we talked a little bit about the theory behind the various methods. Okay, thanks everyone.